We start with, hey, welcome to Spin Out, winner Dave, and we kind
I'm
of,
winner.
your winner.
We're here to demystify venture, minimize FOMO for VCs, and we're going to do that through the lens of the GP and the LP.
Great. In this new series, we're focusing on how LPs assess GPs and how you differentiate yourself as a GP. Today, we're diving into team and alignment.
But before we get too far into this, let's do a quick overview. We've taken the ODD document from Coolwater, and we've broken out the different sections. Winner, why don't you kind of cover what we'll be doing in this series?
Yeah, so I'll just do a really brief overview on kind of the big picture topics here. So, on the last episode, we talked about team and kind of like what's the expectation of building your organization and building your team. Today, we're going to go a little bit deeper into team and more focus on alignment. And so, we have a framework to think about that we're going to introduce in a couple minutes here. And then, to give you a little bit teaser of like what's to come, also, in line with our deep dive series on operational due diligence, we will talk about track record, right? Again, how LPs are assessing your track record as it lines up with your, past and current strategy. We are going to talk about terms, right? Like the terms that you put in that contract between you, the GP, and the LP are very important, right? And so again, how are LPs going to assess those terms and think about those terms? We're going to talk about risk management and governance, which is kind of related. It's like a cousin, first cousin to this current episode on alignment, but we're going to go deeper on governance in a future episode. And then we're also going to talk about kind of compliance and regulatory, as well as kind of like the back office, the finance, the accounting, and the administration. So there's going to be a lot more to unpack in this series over the next few episodes, but we're going to break it down simply kind of one by one. And today's episode is really focused on team and alignment.
Great. And Winner, as you and I were talking earlier, I think there's a good 3-part framework that we've come up with to think through specifically team alignment, both with the LPs and internally within the GP. And so those are strategic. So the issues associated, making sure the whole business, the partnership, everybody is going in the same direction. There's economics, specifically the money, and how those are used as both, incentives as well as kind of checks and balances on GPs to make sure that the internal machinations of the partnership are aligned. And then lastly, we have structural, which deals with how some of the terms in the documents, how the businesses interact, and whether or not GPs are working towards the fiduciary responsibility they have with LPs.
Yeah. Yeah, it's a great framework, thinking about it from the strategic angle, thinking about it from the economic angle, and thinking about it from the structural angle. So let's break those down one by one. So firstly, on the strategic angle, right? I think what we're talking about here is mainly investment alignment, right? So taking a step back, if you're a GP and you're investing into deep technology, you will find investment alignment, strategic alignment with many LPs, with many investors, with many co-investors. So I think that is a form of alignment to really understand. And it's, a really key part of the investment diligence when a LP is diligencing you to, invest, right? Like it's a very core piece of, making sure there's a strong partnership. So that's not necessarily economic even at that point in time. It is more strategic. Another way to think about it is, from a family office perspective, potentially they have a investment strategy that focuses on co-investments. So they want to invest in you as a fund, but they also want to do co-investments with you, right? Like that is strategic alignment. And so as you're building your business, as you're building your firm, as you're, thinking about building your fund, you do need to think about that alignment, that investment alignment, that strategic alignment.
Great. Yeah, that's super helpful. So, thinking about some of the partnerships that GPs make with different types of LPs, I imagine it's also sometimes they meet LPs that have specific mandates or requests for the partnership or expectations of the partnership as well.
Yeah, that's absolutely right, Dave. I mean, if you think about it from the corporate side, right, like a potential corporate strategy or corporate mandate that's out there looking for an investment opportunity, right? Like a fund is going to have clearly defined investment objectives. This could be check size, this could be industry focus, right? That's alignment, like a corporate mandate aligning with your investment objectives that are, clearly written into your LPA. Thinking about those things, right? Because the LP, when they're diving into the details, assessing your fund, they're going to be thinking about those things. And just making sure, one, you're aware of where that's written in your documents, and two, kind of like how that actually, matches up with kind of the, a corporate mandate or strategic alignment of another investor. And then thirdly, and very importantly, it comes down to the management, right, of that expectation over the course of investing your fund. If an LP invests into your fund with a certain expectation because you've defined investment objectives a certain way, right? Like it's your responsibility and really your obligation to kind of carry out the investment strategy, under those investment objectives. So that's a little convoluted as a statement, but what it basically means is LPs invest into you for a strategic reason, right? Even if they want financial returns, they invest in you for a reason, and you need to deliver on their expectation, right? Because it's usually clearly defined in your documents.
Yeah, I mean, the way I always kind of address this, especially recently as we're building a lot of annual general meeting decks, is LPs want to see that you did what you said you would do, right? That is an important part of this partnership. All right, so let's switch topics a little bit. Let's talk about the economic alignment. And so generally, you and I have thought through economic alignment in two parts, right? There's the alignment between the GP and the LP, but then there's also the alignment within the team as well. First, let's talk about the GP LP economic alignment. So what are those kind of like big things that help indicate to an LP that the GP and the LP will win together in your mind?
Yeah, so that's the key question, what you just said, right? Like, are we winning together? I talk to a lot of endowments and foundations, and that's usually one of the key things they're thinking about, which is like, if you win, do I win as well? Right? Like, are we winning together? So what that means is if you're making money as the GP, am I as the LP investor also sharing in that upside to a significant degree, right? Because you are, in fact, as the GP using my endowment money or, wherever it comes from from the LP side, you are using, my allocation, my money to make these investments. So there's it's a commonplace theme to, want to win together.
I think you see that a lot in the conversations between big funds and institutional LPs, and then some of the conversations the emerging funds are having, where the big funds are structurally set up differently, where the management fees do present potentially some moral hazard compared to the potential benefit of carry. And I think LPs generally are waking up to that larger, maybe potential misalignment. So that makes a lot of sense. What about, in your mind, the idea that the GP commit is really important to LPs? What does a GP commit really kind of indicate for, high net worth individual investors as well as some of the fund of funds and institutions?
Yeah, GP commitment is one of those specialized terms, right? It basically means that, you're raising a fund. Most of the capital in that fund will be third parties. Like if Winter's raising a fund or Dave's raising a fund, most of the capital in Dave's fund will not be Dave's money. But Dave, as the GP, right, can be aligned with those other investors by making a commitment, typically of cash, into that fund. So that's the GP commitment. Dave's the GP. He commits usually cash to his fund alongside his other investors. Now, you can think about it, right? Like if you've been very successful as a founder and you've made a lot of cash and you have effectively what some people would call like, a retirement nest egg, and now you're doing your next thing, right? If you're a very small GP commitment, like if you're putting a little bit of cash into that fund, that may be viewed, not always, but that may be viewed as misaligned with your other investors, right?
Not having enough skin in the game.
Yeah, an example would be, so we backed a successful entrepreneur and they were raising a $50 million fund and they put $15 million into the fund. That was their GP commitment. That is viewed from LPs as significant. Typically it's 1% to 2%. So 1% of a $50 million fund is like $500K, 2% is $1 million. They did $15 million. So very confident about their investment strategy. And again, they're using economics as a way to align with their other investors. So they actually anchored their fund with their own money, right? And that got other investors confident in kind of backing them in the early days. And so GP commitment is a mechanism to get other people excited about your opportunity and kind of, it's a demonstration economically of your confidence in the strategy. And it's, one of those things that I think LPs view very importantly. One other thing I'll kind of mention is if you're doing SPVs, which are again, single asset, special purpose vehicles, they're usually a fund that's created just to invest in a single asset. It could be viewed by LPs as misaligned if you're not putting your own capital into that vehicle as well. And many LPs that I know do pass on investing because again, to your words, Dave, like they don't have skin in the game. Like they're not
Yeah.
putting their cash into those SPVs.
And there's another side to this too that I think specifically impacts emerging managers, and that's how much of your GP commit can be made through a cashless contribution. Because there's always a balancing act between using some of your management fees to pay your cashless contribution, not having those resources to build the sustainable investment management business, and then maybe not also having enough skin in the game. But there is a lot at risk for an emerging manager already, and I think we have found some elegant solutions to build that kind of alignment between emerging GPs that may not have that 15 million, but need to show some commitment and can do that through sweat equity.
And this isn't for everyone, but I've even seen some smaller funds defer management fees. So they've actually invested more, right? Where typically they take that capital as management fees. They kind of overinvest near term, expecting to kind of like pay back their management fee liability when they start to get distributions. So again, that's a kind of form of alignment, because you as the GP are demonstrating confidence in the companies you're investing into, optimism in the companies you're investing into, kind of saying like, hey, I believe that, my marginal dollar near term is more valuable than me taking a management fee. Like I think I can 3 or 5 or 10x this dollar put into the ground now, and that, I'll pay myself back the 1x management fee, in the future. So I think the heuristic here is, as the GP, what are mechanisms that you can employ that demonstrate, economic alignment and optimism, that the LP can get excited about when looking at your fund.
Cool. Great. All right. So let's switch now. We're going to go from GP LP alignment to intra GP alignment. The team members that help make up the investment committee and the sourcing, selecting, and winning, how do we properly align them and incentivize them? And at the same time, make sure they're focused on, if you have multiple funds, the right vehicles at the right time. So there are a few different ways we can kind of talk through team alignment, and how best do you kind of advise GPs now?
Yeah. So again, taking a step back, there's 2 parts here. There's the LP GP part, right? And most of the capital you're investing is LP money. And then there's the profit of that's generated, right? So the team economic alignment is based on, I guess, how you divvy up that profit pie. And there's different ways to do it, right? There's different, I would say, frameworks within this bucket of team economic alignment. One very common way is, the founder that starts the firm. They're usually investing the most amount of capital, the most amount of time, the most amount of resources. They put it all together. This is usually a multi-year effort, right? Yep. Many times, like they will have the lion's share or a large share of the economics, and that's one kind of common form that you see, right? When that happens, we're not making a judgment on these different types, but when that happens, the LP will say, okay, that's the important person, right? That person cannot leave. So from the LP assessing that as an investment opportunity, if that person leaves, right, that's usually key person risk. So like we won't go into the key man or the key person clause, but that is kind of, you can identify who are the key players in the organization by who has the economics.
I was going to say, sometimes even that first conversation I've had with several managers, that there's, the profit share, the carry that you were talking about, but there's also the capital contributions, that GP commitment. And inside the GP, you may even have team members that have some carry granted to them, some team members that are also capital contributors to the GP and get carry as a result. And often your more senior people will contribute capital to show that skin in the game with the named GPs. So usually your investment committee members, people voting, they may have titles like director or partner or things like that. You often will see them kind of have both considerations outlined in agreements or inside some of these ODD documents.
Yeah. And so I think we're not going to go into kind of the details of how to structure these, because that, is a whole nother episode. But the big picture thing here is there are roles and responsibilities. And if you are instrumental to the business, right, primarily as an investor, right, if you're a key player on the investment team, executing the investment strategy, building out the portfolio, then the LPs really want to understand that you're properly incentivized over the course of that investment period, right? Because they're maybe writing, $500K or $5 million or $50 million into your fund, right? And they want that capital wisely deployed. And if you can do it with one person, there are solo GPs, But if you're a team and the LP is assessing and betting that it's going to take a team to execute this strategy well to build out the best portfolio, then you really have to think about like what properly incentivizes those people that you are, kind of allocating carry to, what kind of gets them incentivized. And it doesn't necessarily even need to be on the internal team. It could also be different ways to incentivize advisors, right? So maybe maybe an advisory network for you is a sourcing network. So you could look at that kind of divvying up the profit pie. Like maybe you're incentivizing advisors to share with you more deals. Another way to structure that is maybe you're actually sharing a larger percentage of your profit pool with those people that successfully bring you the best deals, right?
Mm-hmm.
So it's not like you're assigning it up front, but you're assigning carry based on success of bringing the deal to the table. So the deals you end up doing, whoever brought you that deal, that's the advisor, right? I think the old way of advisor was here's some carry up front. Now, please go do this. I think the new way of advisor is, hey, here's the carrot. Bring me something good and I will give you kind of the carry because that's an amazing opportunity you just brought me. Thank you so much. Right. So I think there's thinking about, again, like what's the proper way to kind of, give out the profit pool is something that LPs just obsess over and think about very critically when they're underwriting.
And I think to your point, like it is evolving and changing. It's not just something that you can pull off the shelf, copy and paste from someone else. Like it takes a little bit of time to think through how you want to build your business. All right, we've talked about the strategic alignment. We've talked about the economic alignment. The third part of our framework here is structural alignment, right? So you and I have kind of seen many different models of how venture funds are built. We've seen GPs raise them as solo GPs, as teams. We've seen people take on other business activities associated with venture, studio models, incubators, accelerators, all kinds of different ways of bringing people into the fund ecosystem. How should GPs be thinking about some of the structural alignment they have with their business and with their LPs?
Yeah, hugely important topic. Again, there's a lot to unpack here, but there are certain things, especially with respect to the operational due diligence process, that an LP is trying to assess. So, I'm an LP. I want to invest in someone so that they're managing my money, typically full time, right? Like, especially if I'm giving them a lot of money, like I want them to be focused on allocating that to the best of their ability all the time, right? And so, one thing to think about is outside business activities. Like if your fund is not your full-time thing, that's a yellow flag, could be a red flag, right? It's kind of like we looked at a fund the other week, it was 4 partners, but no one was full-time. It was a beautiful ship, but there was no captain. There was a crew, but they were still on shore. And for LPs, that's very hard to bet on, right? So if you're doing outside other business activities, it's a yellow flag. Potentially they could turn into a green flag where maybe that your strategic involvement in something else actually leads to, better sourcing, better network for diligence, right? Maybe that's a positive thing, or maybe it means like no one's at the helm of the ship and the ship is, just heading off in whatever direction. So it could be both, but if you, don't properly define outside business activities, then there is a potential yellow flag there.
And I've seen a lot of LPs care about this in terms of how they set limits or terms around, the amount of time a GP needs to focus, or they'll set limits of how much capital per fund has been either invested, allocated, or reserved before a subsequent vehicle can be launched, trying to make sure that the GP is focused on the main thing at this time. And I think with the proliferation of all the different types of vehicles, you've got the founder roll-up vehicles, you've got lots of emerging, managers, and then you've got corporates, you've got a lot of people out there raising venture funds that aren't the exact same venture fund model that many LPs may have in their mind. And so it's definitely important to understand how it plays inside their own business as well.
Yeah. So structurally, this could play out as like, you can't raise, you need to spend this amount of time on the fund, right? Or you're in breach of the contract, or you can't raise another fund until this amount of time passes, right? Or if you do, like you're in breach of the contract. So structurally, right, like the LP is trying to think through, these terms so that you're structurally aligned with, again, executing on the investment strategy very well. Yeah. Another thing to think about with respect to terms there is sometimes, right, like especially if you're a smaller fund and you're kind of an earlier fund, like in your journey of building a bigger fund, you might have side letters, right? So you also have to think about different terms with different LPs. And that could be structural misalignment, right? Some LPs might want to understand, the agreements you have in place with some of your other parties. And if you put in certain terms into those side letters, that might actually create misalignment with future LPs. So you need to think really critically about kind of what terms, make it into contracts with LPs that are kind of outside of your core LPA.
Yeah, that's well said. So I think one of the things to kind of recap all of this and bring it home across strategic, economic, and structural is really what it comes down to is if you're unsure, like start with the first question every investment manager should ask themselves is what would my fiduciary duty tell me to do? And from there, I think you'll answer a lot of these alignment questions because really what alignment is it's a set of carrots and sticks, checks and balances to make sure that as we move through a marketplace over 10 years, that we make these decisions with each other's interests at heart. And if it's done really well, then GPs don't really get a lot of flack from their LPs. And so this is all meant to make the partnership stronger.
Yeah, I think this is what do you do when no one else is watching, right? Like if you're not being judged from peering eyes, like do you still hold the door open for your grandma? Like the answer should be yes, right? And so I think that's the fiduciary duty concept of this whole alignment piece. It's like there's the letter of the law and the spirit of the law, right? And I think, if we are successful, with this episode, it's like conveying that there's a letter of the law, there's a letter of kind of what your contract says with your LP, but there's also like a spirit of it as well, right? The fiduciary duty of doing the right thing. And if you, don't understand what that right thing is just yet, we have a upcoming episode on governance. So we'll talk about it then.
Yeah, absolutely.
All right, let's transition to our Did You See portion of the episode.
So there's been a flurry of activity, right? Both on the exit front as well as the financing front over the last few quarters. So I think we're going to dive into some of the market data we're seeing. And yeah, Dave, why don't you take it away?
Yeah, as always, we like to pull out the actual Carta market data that we use to power some of the fund models that we're building for people. And one of the things we noticed as we were going through recently is TVPI is starting to trend back up. And so now 2 quarters in a row, especially in the later stage vintage funds that have older assets, we're starting to see TVPI trend back upwards again. And I think that's indicative of a couple of things. One, LPs and GPs are starting to come to grips with the marketplace that they're in. GPs are finding liquidity as few and far between as they can through either secondaries, that increased M&A activity that we're all seeing, and some of the recent liquidity in the IPO market. And I think that's going to continue. So as we look for the Q3 data to come out here in the next couple of weeks, I wouldn't be surprised to see that continued trend in TVPI for 2017 to 2020 vintages continue to tick up. And I would imagine we'll start to see the same for the more recent vintages with the younger portfolios that are now starting to progress towards Series A and B. So it's not going to be floodgates, everyone's going to be winning the lottery, but I think we are starting to see a change in the trend that has been the norm for the last year and a half or so in fund metrics.
And that's positive news, especially for thinking about LP dollars flowing back into the innovation economy.
Yeah, absolutely. It's all about getting the dollars back out there, distributed.
Thanks, Dave.
Great. I'll see you next week when we're talking about track record, investment strategy, and process, man.
Great. We'll see you next week.